Today's kind of an econ-heavy lecture. This is what I like to think of as the preamble to our actual coverage of social insurance. Today we're going to talk about a lot of the models regarding externalities and public goods and expected utility models for when you think about insurance. There's a lot of econ. So between me being sick and there being so much econ, I think we might feel similarly by the end of lecture. You may be less likely to pass out, but we might feel similarly worn by the end of this. So it'll be fun though, I swear. It'll be fun. I wouldn't have missed this for the world, let me put it that way. Okay, here we go. So today is about market failures and social insurance. So we're going to cover externalities and public goods in the beginning, which you should have seen both those topics in micro, right? Yeah, okay, so I'm sure you've all noticed that there were no readings for this week, a good week. That's because a lot of the topics we're going to cover are review from micro. If they happen to not be review from micro, then they are covered in chapters 5 and 7 in your textbook. Externalities and public goods are in there. Okay, so then we're going to talk about externalities, we're going to talk about public goods, we're going to look at some models, and then we're going to move on to social insurance. We're going to talk about the expected utility model, how we think about agents considering utility over risks. We're going to talk about adverse selection, crowding out, moral hazard, and finally optimal social insurance. We may not get through all of social insurance today, in which case we'll pick it up next time. It'll be fine. Okay, let's get into it. So just to review quickly, remember in this course, markets are innocent until proven guilty. Government is guilty until proven innocent, right? We're always suspect of government intervention until we have a justification. So let's go through our sort of justifications for government intervention again. Well, first of all, when there's an interest in redistribution. The private equilibrium may well be Pareto-optimal. In the absence of all market failures, it will be Pareto-optimal. But we may have views of the distribution of resources that equilibrium entails that are sort of, we don't like them, that we find them suboptimal in some sense. And so we might have an incentive or an interest in government intervention in order to create redistribution. Because we may not like the way surplus is divided between consumers and producers, between high-income and low-income people, between wage earners and capital owners. We might choose to have government intervention to have redistribution. There is the rationality due to market failure, which is something we'll talk a lot about in this class. The kinds of market failure we've talked about previously include market power, right, when there's a monopolist or a monopsonist who is not a price taker but is actually affecting the price of either output or input factors when they choose their quantity. The presence of externalities will lead to market failure. An externality is simply when one party in the market chooses a quantity to demand or produce, they're actually exerting a positive or negative impact on other agents in the market, and those impacts are not internalized into their decision making as to the optimal amount to produce or consume. If there are public goods, the private market will fail to produce an efficient equilibrium. And finally, missing markets due to asymmetric information are an example of market failure, which we'll talk more about when we talk about social insurance. This is particularly true in insurance markets, where one side of the market has more information than the other. We'll talk about the case where consumers of insurance have more information regarding the risks than the suppliers of insurance do, and that asymmetric information can lead to market failure or the underprovision of insurance. And finally, the third major rationale for government intervention is simply paternalism. The governments may think that agents fail to rationally save for retirement, to care for their children, in some cases to the point that they should. They may want you to buckle your seatbelt, et cetera, et cetera. That's simply paternalism, where they think that that individual agents are not able to maximize their utility effectively. Okay, let's go on to externalities. Let's start there. So externalities arise whenever the actions of one party make another party better or worse off, yet the first party, the acting party, neither bears the costs nor receives the benefits of doing so. So there are impacts of their actions that they do not internalize. They're externalities. In the case of externality, market failure arises because the private marginal cost of production doesn't equal the social marginal cost of production, or the private marginal benefit of consumption does not equal the social marginal benefit of consumption. There's some they're not equal. The private and the social are not equal because there's some externality that's occurring to agents outside of the private marginal benefit, private marginal cost. In the case of negative externalities, the private equilibrium will lead to too much quantity, too much consumption or production. In the case of positive externalities, the private equilibrium will lead to too little consumption or production. So if I'm telling you that the problem is that there are these sort of external costs or benefits that the agent acting doesn't realize or doesn't internalize, the solution to this problem is to somehow get them to internalize those impacts of their actions. This can actually happen via private negotiations, according to the Coase theorem. Does anyone remember the Coase theorem from microeconomics? The Coase theorem says that if we can allocate property rights to one side of the market, then we can actually, with the absence of negotiation costs, with a few other conditions, the private market can actually resolve the externality issue and achieve an equilibrium that's efficient even in the social sense. If a Coase equilibrium is unable to be achieved, right, if the Coase theorem can't hold because the assumptions fail, then there's a rationale for government intervention here, that the externalities give rise to a market failure that can then be, that can potentially be fixed by government intervention. So just to review quickly, to give a very short tale of Coase, imagine that there is, let's go back to our paper mill example. There's a paper mill producing paper products. For every unit of paper they produce a unit of dioxin, which they then dump into the stream. Downstream are fishermen who fish for a living. Every unit of dioxin kills X many fish and makes them less productive. The marginal damage function is linear. So one more unit of dioxin kills X more fish, regardless of how many units of dioxin are in the river. So Coase says, so this is a negative externality, right? Because the paper plant, oh, yikes. Read that. Thanks. The paper plant, right, doesn't care really about the dioxin going to the river. To them, the dioxin is just a byproduct of production. They set quantity, examining their private marginal cost of production, and the demand function for paper products. Where those two intersect, that's where they choose to produce, right? That's how they set their equilibrium. But what we're saying is that there is a marginal cost to society of paper production that is in excess of what the plant actually feels, right? That's the cost to the fishermen downstream from all the dioxin killing the fish in the river. So what Coase says is that if you can allocate property rights, this can actually resolve itself, given that negotiation costs are low and that there aren't holdout problems, that the parties can have to get together and negotiate an outcome. But let's say we give the property rights to the fishermen. Let's say every unit of dioxin dumped into the river reduces their profitability by $100. So the fishermen now own the river. They're going to go up to the paper plant, right, knock on the door and say, you know what, your dioxin's killing fish. It's reducing our productivity. We own this river. Every unit of dioxin costs us $100 in profit, so we're going to fine you $100 for every unit of dioxin you dump in this river. Why is this enforceable? Because the fishermen own the river, right? We've given them property rights over the river. And so that negotiation will lead the paper mill to then internalize the damages they're causing, and they'll reset quantity with that $100 fine per unit of dioxin dumped in mind, right? And we'll achieve the socially efficient equilibrium where the social marginal cost equals the private marginal benefit, and we'll have the efficient equilibrium. The same would be true, in fact, if we gave the property rights to the paper plant. So this is according to Coase, right? If negotiations are frictionless and the parties can come together. Suppose we gave the property rights to the steel mill, or the paper mill, sorry. Then the fishermen would say, you know what, they're dumping all this dioxin in their river, sure, but you know what, it costs $100 per unit of dioxin dumped. Why don't we try to just pay them off? We'll pay them off $100 per unit of dioxin dumped. So if we pay them $100, they won't dump that unit of dioxin and we'll be more productive as fishermen. That is also an efficient outcome, right? Because even in that case, when the paper mill owns the river, the fishermen are still able to force the paper mill operators to internalize the marginal damage of dioxin dumping. In essence, we're able to change the marginal cost function to the social marginal cost function, and we'll achieve the efficient equilibrium. The distribution of profits, right, will be different in these two cases, right? If we give ownership to this paper mill or to the fishermen, whoever gets the ownership is better off because the transfers go to them rather than the other side. But the efficient equilibrium is achieved in either case. That's Coase in a nutshell. If you want to hear more about the flaws in Coase that make it less applicable to the real world, please read chapter 5. It's all in there. I don't have time to go through it all right now because we have a lot to get through. Is this really pertinent or sort of pertinent?
I think it's pertinent.
Okay. Well, why don't you tell me?
If the state owned the river, which it does
Mm-hmm.
in this country, then they could still fine the paper mill the same amount of money, and the paper mill could internalize it in all the same way.
All we need is defined property rights. It could be a third party. It could be a third party, right, that owns it. We just need defined property rights such that that someone can actually enforce there's ownership of the river. So any damage done to the river can then be sort of it can be leveraged in order to make the transfers that are needed so the marginal damage is internalized. There are a lot of flaws in Coase. There's holdout problems. with the fishermen. There's a lot of fishermen. They have to come together and agree on making this transfer to the steel mill or the paper mill in the case of the paper mill owning the river. There are issues with, so holdout among the fishermen. There's issues of assigning marginal damage to one, there's more than one paper mill on the typical river, assigning damage to each of the mills. There's the issue of measuring the actual damage. What is the damage? What's the linkage? Is it linear? Is it nonlinear? There's a lot of issues with coasts. And the applicability of the coast theorem to the real world is limited. It's very limited. It's only, frankly, even remotely possible in situations where the effects of the externalities are very localized and there are a small number of actors on both sides. So this could actually maybe potentially be handled. I mean, it could work in another, the state could own the river, but it's really the flaws in the coast assumptions that prevent it from being true in the real world. Just in general, during this lecture, I'm going to fly by stuff. There's a lot of stuff to cover. So if you have a question, I'm all ears, as long as you think it's a really pertinent question and not something that's better held to after lecture. Okay, so coast solutions are likely in small localized externalities for larger, more global externalities like global warming, like endangered species issues, like fisheries issues. Those are all issues that coast is unlikely to really work, right? And that's a case where government intervention can really be justified. Okay, so let's go through the simple model of a negative production-based externality. We're going to go from paper mills to steel mills. That's why I kept saying steel mill earlier. So this is a steel mill, and the steel mill is deciding how much to produce, right? It has a demand function. Our demand function, there's no externality from steel consumption in this model. So the private marginal benefit of steel consumption is equal to the social marginal benefit of steel consumption. So the demand curve is simply our demand curve. There we go. Our supply curve initially, where S equals PMC, is a situation where the supply curve is equal to the private marginal cost, i.e. the cost of labor and capital inputs to produce each quantity of steel, right? It's the marginal cost of producing that level of steel, that quantity of steel, and it's simply the labor and capital inputs, what the firm faces as a cost of producing capital. But this is a situation where we're modeling a situation where steel production actually has a negative externality, some kind of negative environmental externality. That's equal for every unit of steel produced. So the marginal damage caused by 1 unit of steel production is the same as the 9th unit. For the first unit is the same as the 9th unit of steel production. It's flat. The marginal damage curve is flat. So when we try to reflect this marginal damage and plot the social marginal cost curve rather than the private marginal cost curve, what we're going to do is lift the private marginal cost curve by a fixed amount marginal damage, right? Because what we're saying is that there is a negative externality from each unit of steel produced that is equal. Right? It's like $5 of negative externality per unit of steel produced. So we're going to add the marginal damage to the private marginal cost function and get the social marginal cost of steel production. And that's our red line. The presence of this next negative externality means that the private equilibrium, what we call point A here, with Q1 being produced, is too much quantity. Because there's extra cost to that production. That's the marginal damage to the environment or to some other party. So if we actually reflect that marginal damage function, or the marginal damage of production, and we look at the social marginal cost function, the equilibrium is in fact B, at a lower level of quantity, Q sub 2. Any questions about this? One way we could force this firm to internalize the marginal damage its steel production causes is by levying a tax T, which is equal to the marginal damage function, right? Because what that would do is transform the firm's private marginal cost function from the blue line to the red line, because it would be internalizing the damage it's causing to the environment, because it would pay a tax of T equal to the marginal damage for every unit it produced. And thus it would choose the market equilibrium would then become B, right? Because the tax would force it to internalize the marginal damage. So this is one way we talk about externalities. There's another model in which we discuss externalities. So in this model, the x-axis plots pollution reduction. So as we move from left to right, pollution is going down, reduction is going up. As we move from right to left, as we move towards the origin, the amount of pollution is actually going up. Our initial equilibrium is the point A, right? This corresponds to this A, where the private equilibrium is A, and there's no reduction in pollution, right? Whatever the private equilibrium wants as quantity, that's A, and there's no abatement involved. I'm going to use the words abatement and reduction interchangeably. I might also use the word scrubber to describe a pollution reduction technology. A scrubber is something you kind of attach to a smokestack that takes out some of the dirt and the compounds that are in the air and cleans up the air coming out. I'll also use scrubber to describe something that's cleaning up sludge. I'm not that technical. So scrubber is just my sort of catch-all term for the technology that reduces production. I'm going to call it pollution reduction, pollution abatement. This all means the same stuff. Okay, so A is our zero reduction full pollution equilibrium, right? We said that the marginal damage of each unit of pollution is flat, right? Some constant amount like $5 or something. So the marginal benefit of each unit of pollution reduction is also flat, right? It's the same $5. So the social marginal benefit is equal to the marginal damage amount. Social marginal benefit of pollution reduction is a flat line. Remember, what we're plotting here is pollution reduction. So we're talking about social marginal benefit of pollution reduction, and it's a flat amount. And then we have our blue line, which is the cost of pollution reduction. It's an increasing function because it's easy to get rid of your first unit of pollution, right? You put on a cheap scrubber, it's gone. The second unit's a bit harder, you need more expensive equipment. The last unit's pretty expensive to get rid of, right? To eliminate the very last unit of pollution is very expensive. So we have an upward sloping marginal cost of abatement. This is a case where we're saying that there's a negative externality to steel production, but there's no externality to abatement, right? The fact that you're installing the scrubber has no externality. That's dealing with the externality. The externality comes from steel production. This is the market for pollution reduction is the way to think of it. So, okay, so we have and this is a case where our private marginal cost of pollution reduction is equal to our social marginal cost of pollution reduction because there's no externality from pollution reduction itself. Okay, so we have our social marginal benefit function, our social marginal cost function. The socially efficient equilibrium will be where these two lines intersect, which is at point B. So point B is where there is a level of pollution of P star, a level of pollution reduction of R star. P star and R star are complements. It's sort of like labor and leisure, right? It's like consumption period 1 and savings. They're just complements. So the optimal level of pollution is P star, the optimal level of reduction is R star. And we know that that level is costing on the margin MD, right? That last unit costs MD to abate, to reduce pollution. Okay. So let's go back for a second. Let's go back to this model. So if I wanted to sort of achieve this, right, if I wanted the firm to actually do this, we could think of a couple different ways for me to make this happen in the market, right? I could say that the firm has to pay a tax, T, equal to the marginal damage, right? And that way, the firm would internalize the cost and choose to abate such that they achieve a pollution level of P star, because they would be feeling that marginal damage they're doing. The other way I could do this is as the government, as the EPA, I could say, you know what, no more pollution than P star. That's it. That's all the quantity of pollution you're allowed. After that, I come shut down your plant. The first taxation is sort of a price-based instrument to change policy, to change the behavior of the firm, right? When I come in and say P star is it, you know, you gotta abate at least R star. That's a quantity-based regulation of the pollution this factory is putting out, right? If I had the information as to what R star is, right, or if I had this firm's marginal cost of abatement function, if I had this blue line, if I had that functional form, and I knew marginal damage, I could either choose to impose the tax as the EPA, or I could choose to just say, you know what, it's P star, because I'd have both of those facts at hand, right? Right. I could choose to tell them the tax is T equals to MD, even without knowing their marginal cost function, right? I would care what it is, but I wouldn't need to know it in order to enact that policy. So in order to actually figure out what pollution level is efficient for society, I need both the MD curve and the private marginal cost of abatement curve, right? Right. Okay, we're going to now talk about two cases where sort of, you know, here I said, you know, it's pretty, we could do taxes, we could do quantities, it's one firm, it's one pollutant, it's pretty straightforward. We're now going to talk about two ways that complicate, two wrinkles to this problem that could make the choice between quantity-based instruments and price-based instruments harder or more interesting. One is that there could be multiple firms. We're now going to think of there being two steel plants, steel plant A and steel plant B. Steel plant B is old. It's a very old plant. It was built without the notion that one day this plant might have to reduce pollution in mind. It was built without any concern for pollution reduction in mind. So actually, for plant B to reduce pollution at all is very expensive. Plant A, on the other hand, was built more recently. It was built by designers who had some notion that the government might actually come in and ask them to reduce pollution. So it was built in a way that reducing pollution in plant A is actually cheaper. How can we see that in these curves? Well, first of all, plant A can actually reduce 50 units of pollution for no cost at all, right? How do we see that? Because its intercept is at 50. Also, everywhere, each additional unit of abatement is cheaper for plant A than is for plant B on the margin, because the marginal cost curve for A lies everywhere below the marginal cost curve for B. So pollution reduction is much cheaper for plant A than it is for plant B. If we want to figure out what the total cost, the marginal cost for this industry, imagine these are the only two steel plants in America. If we want to figure out what the marginal cost of pollution reduction is for the steel industry, how do we do that? We sum horizontally, right? We sum at $100, x plus y equals z. That's how we get this marginal cost of t function. We add up horizontally at every point. So marginal cost sub t is the industry-wide marginal cost for abatement. The socially optimal level of pollution reduction will be at z, which is 200 units of reduction. How that's divided by the two firms is dictated where they're in. We just know, where did we get mc sub t from? We just added up the other two. So we know that where they intersect, the same line is going to tell us how much they should each do. It's efficient in this market for firm A, our newer firm, to abate 150 units, and for firm B to abate 50 units. This is when the marginal damage of dumping is $100 and it's flat. So suppose as a regulator, if I went with a tax, right? Suppose I put a tax of $100 per unit on this industry. Would I get the efficient equilibrium? What would happen if I levied the tax of MD? If I put a $100 tax per unit of steel produced? How many units of pollution reduction would firm A undertake? 150 is exactly where that intersection is, exactly. Firm B? 50. That's efficient, right? That's exactly what we want. That's the sum of $200 units of reduction. That's perfect. That's exactly what we want. The tax instrument works well here. Suppose as the regulator, I knew the industry-wide curve. I knew MC sub t. So I know that the total amount of reduction I want in this industry is 200. But let's imagine I'm a dumb regulator. And I say, okay, there's two plants. Let's have them each do 100. That seems fair. There are two plants. We want 200 units reduced. Let's have them each do 100. Would that be efficient? No, because that would mean firm B is over reducing relative to the socially efficient equilibrium, right? Because them doing 100 costs, look at the marginal. The marginal cost of their 50th to 100th unit is really high. It's well above $100, right? That's where all of this loss comes from. That's inefficient. Firm 2, on the other hand, only undertaking 100 units is also inefficient because they have much lower costs of abatement, right? What it should be is that firm A should be undertaking a lot more abatement, and firm B should not be undertaking as much abatement because it's much more costly for firm B to undertake pollution reduction than it is for firm A. There's another way. I could set the quantity, but allow for the heterogeneity of firms to actually work for us, right? To harness this sort of differential efficiency of pollution reduction. What's that called? Does anyone know? Cap and trade, right? This is a situation where I know the total amount of reduction I want, but I don't have information regarding the marginal cost of abatement for the two firms. All I know is that I'm pretty sure they're different. They're not the same. So what I do is suppose we had 1,000 units of pollution initially. I want to reduce that by 200 units. I'd issue permits for pollution. I'd issue 800 such permits, right? 800 permits for 1 unit of pollution each. I could divide them up any way we wanted, right? Some people might say, let's really protect our old industry guys and give a lot of them to firm B. Some folks may say firm A is, our new hungry youngin'. Let's give them more of the permits. We might split the difference and say, let's give them each 400. I assure you it doesn't matter who gets how much of the permits for the efficiency of this outcome. Because what's going to happen is that the value of that permit is going to be bid up until it is equal to the marginal cost of abatement for the most efficient abating firm, right? That's what's going to determine it. When the day at which firm A realizes that, they could abate, because it's always cheaper for them to abate until they get to 100, right? And it's always cheaper for firm B to buy permits rather than abate until the price gets to 100. And that's where equilibrium will be reached. The price of the permit will adjust to achieve the efficient allocation of pollution reduction, given that the total quantity of reduction is right. Given that we got the 200 right, the firms will allocate the permits between them such that they each efficiently reduce as they should. So as long as I set the total quantity of reduction at 200, it will turn out with a permit trading system that firm A will reduce by 150 while firm B will reduce by 50. They'll figure it out because the price of the permit will adjust to allocate pollution reduction efficiently across the two firms. So there might be political reasons to give the permits to one party or the other, right? Really powerful congressman lives in the district that Plant B is in. The White House really wants to foster other technologies being developed by Plan A. There might be political reasons to allocate the permits differently, right? But the efficiency of the outcome has only to do with getting the total quantity of permits right. Okay, so let's talk about this again with this wordy slide up here. So the policy options for heterogeneous cost of reduction. Quantity regulation, right? The efficient solution is one where for each plant, the marginal cost of reducing pollution is set equal to the social marginal benefit of pollution reduction, i.e. the marginal damage. The reduction is 150 for A and just 50 for B. A uniform reduction, right, was not efficient because they have differential costs of abatement. In the case of a Pigouvian tax, that's where we set a tax equal to the negative externality that the firms are causing. The firms get tax savings, right, from not polluting. So they're going to reduce production such that they achieve the efficient equilibrium. Because what the tax does is simply force the firms to internalize their externality. And finally, the last thing we talked about is tradable permits. Trading, right, the ability to trade those permits between or among the firms allows the market to incorporate information or incorporate the differences in pollution abatement costs across firms. Those are our three sort of policy instruments. One of the things that's not in this, right, because this is a static model, there's no time dimension here, but as policy people, one of the key sort of policy questions is, does one of these instruments really do a better job of fostering or incentivizing the creation of technologies for abatement, right? Because the best way to reduce pollution in the long run is for all of these curves to flatten out, for the marginal cost of abatement to fall for firms, right? That's the really efficient way to reduce pollution in the long run. And so it's sort of one of the things to think about, and I don't have an answer for you, but one of the things to think about is which of these policies creates the right long-term incentives to build innovative sort of prowess in pollution abatement, right? In a cap-and-trade system, we can imagine a system where, we say this year, we're going to reduce permits by 200. So it'll be 800 permits this year. Next year, there's only going to be 750. The year after that, 700. We put the industry on a trajectory that says, you know what? Without the creation of more efficient abatement technologies, the price of permits is just going to go up. Right? That's one way to do it. When it comes to a tax, it could be something like we put in place a tax that's rising over time, right? Or if we just go for the total quantity system, that's sort of, we've talked about how it's kind of boneheaded, but it is simple. We could say we're going to reduce those quantity caps over time. Part of it, this is a static model, but a lot of the most important parts of these types of policies is actually dynamic. It's a little beyond the scope of this class, but it's something really important to consider when you think about this stuff. Okay, so that's the effect of heterogeneity in abatement costs across firms and how that complicates sort of our choice of instrument. How are folks feeling? Pretty good? It's going down okay? Everything's fine? Okay. This part's a little bit more complicated. It's about uncertainty. So we're going to talk about a situation where the EPA has done the best research it can and has come up with their best estimate of what the marginal cost of abatement looks like in this industry. And their best guess of the marginal cost of pollution reduction for this industry is MC1. We know that the marginal damage function is MD, and we're going to consider two cases. Let's back up. The EPA has done the best it can to figure out the marginal cost function for this industry. Their best guess is MC1. It turns out that the EPA was somehow wrong, that their very best research somehow underestimated the costs of pollution abatement, and the true marginal cost curve is not MC1, but it is instead MC2. Notice that MC2 is simply a vertical lift of MC1. So they've underestimated the marginal costs. Their underestimation is a flat amount across the curve. We're going to consider two cases where there's this surprise in the cost. One is a case where the marginal damage function, where the marginal damage is what's happening to the environment for every unit of pollution produced, is really flat, and one where it's very steep. Notice now, before we were talking about a marginal damage function that was horizontal, now there's some downward slope to it, right? What does a downward slope mean again? It means that the initial units of damage are much higher in terms of the initial units of pollution exert a higher marginal damage per unit than the later ones, right? That's all the downward slope means. We're going to talk about two cases. One where the marginal damage function is really flat like this, one when it's really steep like this. Notice that the difference between MC1 and MC2 is the same in these two models. They have the same slope. Okay, so let's start here. Let's start with the blue lines. The marginal damage function is certain, it's just very flat. So this could be a situation where, this is the example in the textbook of global warming. Why is the marginal damage function really flat when it comes to global warming? because we're talking about abatement this year, most of the cause of global warming, right, is CO2 that's already up there. I mean, we should abate. There's no reason not to abate. It's really costly, but there's some reason to have some interest in abating, right? But most of the cause of global warming is already behind us. Making it worse may not be a good idea, but the sort of gain or the marginal damage of one more unit of carbon, of CO2, given how much is already up there, is pretty flat. It doesn't matter that much. So our marginal damage function here is really flat. So this is again the case where, EPA has done the best research it can to figure out the marginal cost for industry is for pollution reduction, and their guess was MC1 is the curve. So according to EPA's best guess, the ideal amount of pollution reduction is R sub 1, right? The equilibrium should be C, the amount of reduction should be R sub 1, the amount of pollution should be P sub 1, and it should be at a cost of C sub 2. That's what EPA's sort of model in mind is. So suppose it turns out that, the costs are actually higher. The costs are MC2. If the costs are MC2, the equilibrium should be R sub 2, right? R sub 2 amount of pollution reduction, because the equilibrium is B, R sub 2 with a pollution level of P sub 2. That's what in reality should be the equilibrium. But remember that EPA thought the model was equilibrium C with R sub 1, P sub 1. Suppose in order to achieve equilibrium C, right, and have R sub 1 level of pollution, the EPA put in place a quantity regulation. They told industry, you can only pollute P sub 1. You must reduce by R sub 1. This is what they told the industry. EPA has gotten it wrong, right? That's no longer the optimum. There's going to be too much reduction of pollution, right? We're going to over-reduce. By how much? Well, this should be the equilibrium quantity. This is the equilibrium quantity. This gray triangle, ABC, is the deadweight loss of EPA getting it wrong, right? Does everyone see that? Because we've over-reduced by units R sub 2 to R sub 1. Each of these units between R sub 2 and R sub 1, the marginal cost of eliminating that unit of pollution is higher than the benefit, which is the reduction in marginal damage, right? It's higher than the social marginal benefit of getting rid of that unit of CO2. So all of this is wasteful, right? And it's wasteful because EPA just got it wrong, right? The curve is actually slightly different than they thought it was. So the deadweight loss in this case of getting it wrong, if we did a quantity regulation, right, is ABC. Suppose in order to achieve equilibrium C, instead of doing a quantity regulation, the EPA put in a tax. And they put in a tax at level C sub 2, because that also corresponds to the equilibrium at point C, right? So they put in a tax of C sub 2. If this is the true industry cost function, where will industry choose to produce? How much pollution reduction will it undertake? Where will the real equilibrium be? Anybody? E. Exactly. Because that's where the real marginal cost curve intersects the tax. So they're going to abate by an amount R sub 3 in the case of a tax. And they'll pollute at P sub 3. Is that more or less than the best equilibrium? Less. So there'll be under abatement here. Too little pollution reduction. There'll be too much pollution. But in this case, the deadweight loss is dBE, which is smaller than the other case with quantity regulation, right? And the reason behind that is because our marginal damage function is so flat. The deadweight loss from putting in a level of quantity regulation that's too high will be larger than the deadweight loss from under abating because we've relied on a tax. Because what happens is if there's uncertainty about the cost function, the true cost ends up being too high. The true cost is higher than what we guessed. If we put in a quantity regulation, we'll over-abate. If we put in a tax, industry is going to under-abate because the marginal cost is much higher than they thought it was, right? So that tax is going to lead to less reduction. The reason why this deadweight loss pattern works this way is that in the case of a really flat marginal damage function, we aren't actually that worried about getting the quantity absolutely right? Because the curve is so flat, the consequences of getting it a little wrong are not that big. But the cost of forcing industry to over-abate are really high because the marginal cost curve is so much steeper than our marginal damage curve here. So in the case where our marginal damage function is really flat. Our curve is really flat. Quantity regulation will lead to more deadweight loss if the costs are understated than taxes. Remember here, this is an upward shift in the marginal cost curve, right? And this is because here we don't care so much about the quantity and getting it right. We want to reduce, but if we reduce by a little bit less, it's not the end of the world because our marginal damage function is really, really flat. Let's look at a different case. This is like global warming, right? Now let's look at nuclear leakage. So nuclear leakage, for whatever reason the equilibrium is at C, I actually think that the equilibrium should be somewhere way over here, right? Like nuclear leakage is not good stuff. We want very little of it. It's very, very important we get the quantity right. Maybe it's C if we're including some leakage that's happening somewhere that no one lives, right? Like, Nevada. I kid. God, my jokes are really bad. Anyway, so it's at C, right? So nuclear leakage is a thing we care a lot about the quantity, right? That's why the marginal damage curve is so steep. Once there's been toxic waste somewhere, once nuclear leakage has occurred, that first unit is pretty much the key unit, right? Once a little bit of nuclear leakage has occurred, the place is pretty much contaminated. The marginal damage curve drops off pretty quickly because this is a place where you want zero. You really, really want zero. Or there's some initial level after which you're in trouble, right? Once you get to point whatever where this curve starts, you're in big trouble. There's some amount you can probably tolerate, but after that you're in big, big trouble, and really once you reach that level, it's bad. No matter how much worse it gets, it's still bad. Okay, that's why our marginal damage curve is so steep. Notice here, EPA has made the same basic mistake. It thought the MC1 curve, it thought the marginal cost curve was MC1. It turns out it's MC2. The difference is the same between the two graphs. Here, suppose they tried to achieve the equilibrium of C by putting in a quantity regulation of R1. They get it wrong, right? There's just, again, a deadweight loss. The deadweight loss is triangle ABC. Suppose they put in a tax of C sub 2 again. They got it wrong, right? They got the marginal cost curve wrong. Instead of getting R sub 1, we'll in fact get R sub 3, because that's where industry is going to choose to abate to. Notice the deadweight loss triangle DBE here is much bigger than ABC. And that's because this is a place where we care a lot about the quantity. So relying on a quantity-based regulation is going to leave us with less deadweight loss in the case of uncertainty than a price-based regulation. The lesson here is actually very simple. When we care a lot about the quantity of pollution reduction, a quantity-based regulation is the safer way to go. I'm going to stop for a second. When there's uncertainty, what we really care about is quantity of pollution reduction. A quantity-based regulation is the safer way to go. But in the case where what we're really concerned about is the cost to industry of abatement, right? That we really don't want to impose a regulation that ends up shuttering businesses, right? That could very much be the case of global warming, right? Because if we're only acting on the US part of the world economy, we could really impose very high costs on US businesses that could then relocate, right? That could be an example of a place where we're really worried about the costs we're imposing on business. That's the case where the price-based regulation, using a tax, may be the safer way to go. Does that distinction make sense to folks? Because partly when you impose a tax, what you're telling industry is, hey guys, abate until the point where your marginal cost of abatement equals this tax. If you've gotten the cost curve wrong, the amount of pollution reduction will be different, right? You're leaving it in the hands of the marginal cost curve, whatever it might be, when you impose the tax. When you impose the quantity, you're fixing the amount of pollution in the air, regardless of what it costs industry to do it. Right? So if there's uncertainty about cost, you're going to be imposing really high costs on industry. So it's just a trade-off. When you fix the quantity, you could potentially be levying very high costs on industry. When you fix the tax, you're fixing the cost to industry, but you could potentially get a different amount of reduction than you wished for. Okay. So let's talk again about instrument choice. So which of these methods, price versus quantity, will lead to the most efficient outcome depends on, first of all, how heterogeneous the firms being regulated are. If they're all the same, then we can divide up the total quantity of reduction among them and divide it up and it's fine, right? But the more heterogeneous we fear firms are, the more maybe tax-based we'd like our instrument to be, or cap and trade. How important getting the level of pollution correct versus getting the cost of reduction correct, which is that in the uncertainty model. The extent of uncertainty over the costs of externality reduction. The bigger that difference between MC1 and MC2, the more you might want to rely on one instrument versus the other. Right? So one of the homework assignments for this week, this is in exchange for not having reading this week. I want you to go home with this diagram This is called the Weitzman uncertainty framework, and play with it. I want you to play with what happens if you shift the marginal damage curve instead of the marginal cost curve. What happens if the marginal cost curve, you've actually exaggerated it? MC2 is below MC1. What happens if the marginal damage curve has slope to it? Oh, sure. Just play with all the lines. So imagine MC2 is below MC1. What happens then? What if the marginal damage curve is higher or lower than you initially thought? What if the marginal damage curve has slope? And think about what happens to the dead weight loss triangles. Remember, when I ask you to do weird stuff, it usually tells you something about the exam, right? I mean, yeah. So playing with this framework would be a good idea. It's covered entirely in Chapter 5. If any of this is sort of difficult and strange, of course, reach out to me and Vincent, but it's in Chapter 5, and review that. Imagine that it was higher or lower, or imagine it had slope. What would happen to this diagram? Question, yeah? No, pen and paper. Some things in this class are old school. Lots of things, in fact. Yeah, just do it on pen and paper. Foggy bathroom mirror, all of this would work. Okay. And finally, the extent of uncertainty over the damage that will occur, right? Whether we're getting the marginal damage function right. Okay, so I've talked a little bit about externalities, right? But there's often a question I get when it comes to this topic is people have ideas of externalities that aren't externalities, and people think certain things are not externalities that are in fact externalities. So I want to go through an example with you, which is smoking. So smoking could potentially have externalities that are negative or positive. In fact, we'll get to a positive one in a second. And so we're going to talk about a bunch of effects and then discuss it and say it's not an externality if this is true. It is an externality if the other column is true. So one potential externality that some folks suggest of smoking is that the healthcare costs are higher. Healthcare costs increase when people smoke. That's not an externality if insurance companies can simply charge smokers higher premiums. Because in that case, they choose to smoke, they're really expensive to care for, they pay for it, it works out, the rest of us are fine. If there is some sort of regulation or norm that prevents insurance companies from pricing smokers as they should be priced, some folks may call it discrimination, right? Discrimination against smokers. If there's some regulation or social norm that prevents that, so that may be, that in that case, it is an externality. Because we're not able to pin the cost onto the smokers, right? If we can pin the cost onto the smoker, we're fine. It's not an externality. But if other folks end up paying for it, then it is in fact an externality. What about the effect of, smokers tend to be less productive workers on average. Mostly because they have to smoke, right? They have to go out and smoke. It reduces productivity. And if you don't let them smoke, then, they're really wishing they could smoke and not as productive. So on average, smokers tend to be less productive workers, controlling for all of their characteristics. But if employers could just pay smokers less because they're less productive, this would not be an externality, right? If smokers really are less productive and we can pay them a little bit less, then that would be fine. But if there are regulations and employers could not adjust wages according to individual productivity, and then this would be an externality, because the whole firm would bear the cost of the smokers' less productive work time. Smokers tend to be involved with more fires, increased number of fires. So if smokers are only lighting their own stuff on fire, right? If it's only their stuff, and they're able to put it out themselves, and insurance companies can charge smokers more for being smokers when it comes to fire insurance, then we're fine. There's no externality. But smokers tend to not just hang out around their own stuff, right? They tend to be in proximity to other people's stuff. And they tend not to have their own fire departments or able to put out all fires they start themselves. And insurance companies, can in some cases, but not in all cases, charge smokers different premiums. So there could be an externality in terms of starting fires, right? Okay. Earlier death, this is a positive externality. Not for the smoker. Remember, the smoker is not the externality is about the rest of society. What tends to happen with smokers? I'm sorry, if any of you smoke, I really have no problem with you smoking. I don't care if you smoke. It's not a moral issue. This is just about externalities, and it's not a moral judgment in any way. But what tends to happen to smokers? They die, and they die young. Compared to most people, right? So one of the positive externalities of smokers is that they pay in to social insurance programs like Social Security and Medicare, and they don't really collect because they die before they get there. So that's a positive externality because it makes Social Security more solvent. I'm not kidding you. So with the decline of smoking in the U.S., it had like a real impact on the actuarial balance of Social Security. It's also a way that sometimes illegal immigrants help Social Security, because sometimes illegal immigrants use Social Security numbers to get jobs, but then it can't actually collect the benefits because they aren't that person, but they're paying into the system under those numbers sometimes. It depends on the actual the payment scheme, but in some cases that's another way. People are paying, any situation where people are paying benefits, paying in and not getting the benefits, it's a net gain for the system. So that's a positive externality. And also medical care costs later on. Like, of course, when a smoker dies, there are some healthcare costs, but they typically die of just lung cancer, while old people sometimes have multiple very expensive illnesses. Like, they're not going to be the person who has, diabetic issues and has a heart attack and has some other cancer. Like, they're not going to have the trifecta. That can be very, very expensive, right? So they'll die of one thing. We'll pay for the one thing and it's done. So yes, the young death is a positive externality. Okay, and the last thing we worry about when it comes to smoking is secondhand smoke effects, right? Secondhand smoke may have been the first one most of you thought of, to be honest. So some of this, the effect of secondhand smoke on people who aren't constantly around it, there's some various studies, but it may not be nearly as bad as for like the families of smokers, right? But if smokers really internalize the health of their loved ones, of their spouses and their children, and they don't smoke around them, this could be less of an externality than we think it is. There used to be possible to smoke in New York bars, right? And so if I was in there, and I'm not a smoker, so if I was in there and I was trying to enjoy my beer and there's a lot of smoke, it might reduce my ability to enjoy my beer, right? That's a negative externality. It might be true for many people in the bar. We could actually take care of that. If we were all willing to like chip in a quarter to pay that guy to not smoke, we could internalize the externality, right? We could pay him off to not smoke. That's a way of he's sort of internalizing the costs that he's inflicting on us, and equilibrium could be achieved. There's no law against that, but there's a social norm, right? It's awkward to go up to someone and say, can I pay you $6 to not smoke that cigarette? People tend not to do it, right? Because most people are really just not that into those kinds of transactional behaviors. This is a place where more economists would make the world a better place, I think. But so there are also, there's regulations against sometimes internalizing externalities. Sometimes there's just social norms, right? You can't pay someone to get their kid to stop doing whatever they're doing, right? It's not, sometimes you can, but you really, it's generally frowned upon, right? It's generally frowned upon to try to pay people off to change their behavior in real time. I was at Think Coffee earlier today and I was running late, and I would have done anything to just be able to go up to the people ahead of me and pay them off to let me get my coffee, and it's just not normal, right? It's not normal behavior. It's outside the norms. It would take longer to explain than it would to just wait in line. Okay, that's externalities. We're done with externalities. Anyone have a deep question about externalities? Okay, I'm going to say one thing about externalities. So when so imagine me and Valerie are both coveting some item. And I'm a demander and she's a demander. The fact that two of us are demanding this thing increases the price of that thing, right? We don't call that a negative externality. That's something we call a pecuniary externality. And we don't call that an externality because suppose Valerie's desire to buy this item is bidding up the price that I would have to pay. When we think about demand, remember, we're thinking that there's a very close substitute for this good out there for everyone. So if I'm bidding it up and she slightly can't afford it now, or she's bidding it up and I know, there's a very close, maybe rather than this orange, I'm going to be happy with a banana and a half, right, that I could buy for the same price. So that's why we don't call that an externality, because a pecuniary externality, money has other uses, and we have very close substitutes. There are other things you desire very closely. They're close substitutes for your utility. You might require a banana and a half to make me equally as happy as that orange, but the prices will be such that that's possible, right? There are goods that could make me, so we don't call that an externality. Externalities really have to come of the form we've talked about so far. Okay, public goods. Public goods have two characteristics. They're non-rival and they're non-excludable. Non-rival means the fact that I'm getting utility out of it doesn't reduce your ability to derive utility from it. Non-excludable means that I can't stop you from deriving utility from this thing. So let's think of a few different goods. So on this side we're talking about is the good excludable. On this side we're talking about is it rival. So an example of a private good, right, a good that is rival and excludable, is like an ice cream cone. If I'm enjoying an ice cream cone, it certainly reduces your ability to enjoy that ice cream cone, and I can stop you. Maybe if I was bigger, I'd be better at it, but I could stop you from eating my ice cream cone, right? That's excludable, rival and excludable. An impure public good. So is the good, let's think about cable TV. Once the cable for cable TV is laid in your area, the marginal cost of actually putting it into your house is very low. So it's actually not really rival. Because I have cable, we're not going to fill up the whole cable wire. It doesn't reduce my ability to get it because you're getting it. So it's non-rival. Is it excludable? Oh yeah, right, that's why you can't pirate HBO. So that's an example of a non-rival but excludable good, is cable TV. An example of a rival, sorry, I said that. So cable TV is it's non-rival and it is excludable, right? Because the cable company can stop you from consuming it by just blocking you. Example of another impure public good. An example of a good that is rival but isn't excludable is like sidewalk space outside or in this area, right? All those tourists take up the sidewalk space. You can't stop them from doing it, but the fact that throngs of them are walking around stops you from getting where you want to go efficiently, right? That's an impure public good, sidewalk space. But the quintessential pure public good example that's non-rival and non-excludable is like national defense, right? I can't stop you from feeling safe because we have a good national defense system. And because I feel safe doesn't reduce your ability to feel safe from our national defense system. Any questions about what a public good is? There are very few pure public goods. Things that are very close to pure public goods we just think about as public goods. But sometimes there are impure aspects to it. Very few things are truly non-rival, right? There are a few things that are completely non-rival. And non-excludable too. Okay, so don't look up here yet. So how do we normally add up things in markets? Suppose we're trying to add up demand for apples, and I ask Maniza, if the cost of an apple was $1, how many apples would you demand? And you say something like 3. There we go, ESP there. And then I ask Matt, how many apples would you demand at $1? Your name is Matt, right? Yeah. Okay, good. And so we'd add up. Suppose they're the only 2 demanders in this market. We'd add up their demand at a price of 2, and aggregate demand would be 5. How are we adding up when we do that? Like when we added up this marginal cost curves, how do we add up in economics generally with private goods? Horizontally, right? At each price level, we add up how many quantities demanded. You've all wanted to add up vertically. I know. It's your deep desire to add vertically. I'm telling you this is your one chance. Public goods we add vertically. And why is that? It's because when I ask you how much would you be willing to pay for an aircraft, for the US to build an aircraft carrier, how much utility would you derive from that? Just pick a number, any number. Or Valerie, how much utility do you derive from the building of another aircraft carrier by the US? $7 of utility. Vasundhara, how much utility do you derive from the building of an aircraft carrier? Pick a number. I mean, it really doesn't matter. 50. Okay. And then if I asked Kelly, how much utility do you derive from the building of an additional U.S. aircraft carrier? 0. Okay. So we're going to add up 7 and 50 and 0. So the total benefit to people, to this market, the 3 of you, is 57. I just added vertically. And that's the value of that aircraft carrier. If I were to ask how much utility would you derive from 2 aircraft carriers, you would all say numbers, and we'd add up your private marginal benefits to get the social marginal benefit. Because this is a special case, because just because Valerie is getting 7 units of utility from the creation of that aircraft carrier doesn't stop Vasundhara from getting 50 units. It's not like an apple where Valerie is eating it and Vasundhara can't enjoy it, right? And it's non-excludable. She can't stop her. This stuff just adds up because it's a public good. It's a public good. So when it comes to public goods, we add up the social marginal benefit by summing private marginal benefits across individuals. Logically, it makes perfect sense, right? It makes perfect sense. Okay. So efficiency in these markets always implies that the social marginal benefit equals the marginal cost. So here we have individual sort of demand for missiles in this case. Private marginal benefit for each person is the first 2 lines. We add them up to get the social marginal benefit of missiles. The blue line in the bottom diagram. We have the social marginal cost of missiles, which is simply the private marginal cost. We ask, McDonnell Douglas, whoever builds missiles, what does it cost to build a missile? And that's where we get the cost curve from. Awesome. Any other questions? Any questions about this, rather? Cool. Okay. So private markets are going to underprovide public goods. This is because of the free rider problem. If I'm willing to donate $100 to build an aircraft carrier, you feel less inclined to donate because you can fully enjoy my $100 of aircraft carrier, right? If I'm going to build one out of my private funds, you wouldn't want to pay tax dollars to build one because you can feel the full benefits of the aircraft carrier I pay to build. That's called the free rider problem. When an investment has a personal cost but a common benefit, individuals will underinvest. It doesn't always lead to the underprovision or complete absence of the private provision of public goods. there are certain situations, and the real world situations, where folks can come together and actually privately provide public goods. One example of this is something that we see here in New York. It's in business improvement districts. So Times Square is a business improvement district where the business owners, right, contribute individually to a fund that then provides public services to that district, to that area. It's things like trash pickup. It might be additional safety officers, that are working in conjunction with the NYPD. It's sort of local amenities, right, that are provided. Why does this work? Well, first of all, this is a situation where the businesses of Times Square want more public services. Why won't the city of New York provide those? Because the benefits are very locally felt, and the tax dollars would have to come from the whole city. And as we all know, most people who live in New York don't go to Times Square, right? This is a benefit that they would probably never feel, right? And so there is a free rider problem for the whole city. But those businesses that reside there would very much benefit from that public good. And there's a very high individual firm demand for those public goods. They would really like cleaner streets and a safer feeling because their businesses would benefit directly from that. The second reason business improvement districts work is that you only need 60% of business owners to agree to it to get one. So the holdout problem, the idea that, well, if everyone else is going to contribute, they're going to do it anyway, and I'll just hold out and not pay. Right? If you realize that if everyone thinks they want to be the last guy to contribute and does not contribute, what happens? No one contributes, right? But you don't need that. You only need 60% of people to contribute, which breaks down the holdout problem. It's those measures that lead business improvement districts to actually work, so that local groups come together and provide private funds for public goods that benefit them all. So there are some exceptions, but in general, the free rider problem will lead to at least the under-provision of public goods by private markets. It's most likely, again, when there's especially high demand for the public good that the private sector will work. But in general, the private sector will not achieve the optimal level. You can imagine even in business improvement districts, the optimal level of public goods might even be higher than what they're providing. Right? Times Square should be maybe even cleaner and have even more cops and more neon lighting. No, I'm kidding. Okay. So the role of government in providing public goods. So when there are problems with private markets, right, when the private market is under providing public goods, the government has a justification to step in. In fact, a lot of what government does at the local level, at the state level, and at the federal level is the provision of public goods. It's stuff like cops and firefighters. It's stuff like well-maintained roads. It's stuff like public schools even. Right? A lot of what the government's doing, in some aspects, public schools fall in this category, in the sense that a well-educated labor force has benefits to everybody and less crime and all kinds of stuff. So there's a public good aspect to a lot of things that government does. It's actually one of the main functions of government is the provision of public goods. So whether or not the government can actually step in and do this, to efficiently provide public goods to the market, depends on a couple things. First of all, the ability of government to appropriately measure the cost and benefits of provision. To get it right, they have to figure out what everyone's private marginal benefit is, add it up correctly, have the right cost function, and find the right equilibrium. Right? They have to have the right cost and benefit functions. Second, even if they have the functional form right? If they have the right marginal cost function, the right marginal benefit function, they know equilibrium is at point A with a quantity of Q sub 1, there is a real potential for the system to get it wrong because the politics doesn't work. Right? We can imagine that our congressional representatives get a lot of utility from serving their district well, from providing the right level of services for their constituents. But you could imagine, in a perfectly rational, reasonable, no one's being mean about it world, that they also get utility from, being able to put braces on their kids' teeth. Maybe the occasional junket, right? Maybe, the occasional steak dinner. And all of those things have some weight in their utility function that's non-zero, and that could lead for the allocation of public dollars to be somehow different than the efficient allocation of public dollars into public goods, right? And so there's two things that have to happen for government to get it right. They have to be able to get it right, to figure out what the right level is. Second, they have to actually be able to do that. And even the figuring out what it is hard, right? Because if you ask me what my marginal benefit of public schools is, that's a hard question to even answer, right? It's a difficult question to get right to begin with, and for the politics to carry it out can be complex as well. But there is a role for government to step in the situation where the private market is under-providing this public good. Okay, now we're going to move on to social insurance. And we have, awesome. Is this clock right? Can someone check their phone and make sure that's right? 8:45? 7:45? Yeah, this is good. Okay, so remember your job. But you have to do it at 8:10. 8:10, because we have to have our discussion. Okay, terrific. So we're going to get through a bunch of social insurance. Okay, so social insurance programs basically provide insurance against adverse events. No one insures themselves against good events, right? No one's like, in case I win the lottery, please give me more money, right? No one has insurance against good events. You insure yourself against bad events. In the U.S., social insurance programs include UI, unemployment insurance, which is insurance against the adverse state of being unemployed. Disability insurance, which provides insurance against the adverse state of having a career-ending injury. Workers' compensation, which insures against the adverse event of being injured on the job, such that you're temporarily unable to work. Social Security, which insures an individual against the adverse event of outliving your savings. And Medicare, which insures an individual against the adverse event of having extremely high medical expenditures in old age. Okay, so what is insurance? So insurance is a system in which the individual pays a premium and then receives benefits in the case where the adverse event occurs. So I'm going to stop for a second and totally just this is this part of the class that, write this stuff down in like phrases and bullets. So in the intertemporal consumption model, we were smoothing consumption between two periods, right? We were choosing consumption in period 1 versus consumption in period 2. We wanted to equate marginal utilities across two time periods in that model, right? This is an analog, but instead of equating marginal utilities across periods of time, we're equating marginal utilities across states of the world. What do I mean by state of the world? So today, I stand here today, there's a tomorrow, right? Tomorrow could be a day where it rains or it doesn't rain. It could be a day where I have a job or I don't have a job. It could be a day where I have a house or my house has gone up in flames, right? Those are all states of the world. We'll always deal with there being situations where there are two states of the world. The event where the bad event doesn't occur and the state of the world where the bad event occurs. And the way we're going to think of insurance is that in the state of the world where the bad event occurs, the insurance company gives you money. That money could fully compensate you for what you've lost, which is the case of full insurance, where we say that the bad event occurs, you lose $50,000. The insurance company gives you $50,000. That's full insurance. There could be a kind of insurance where the bad state of the world occurs, you lose $50,000 of consumption, but the insurance company gives you $25,000. That's partial insurance. But what's always true is regardless of whether the good event or the bad event occurs, you pay the premium. The insurance premium is paid no matter what happens. So in the case where the bad thing happens and the insurance company gives you money, you're still sending them the premium. On lots and lots of exams that I've graded in the semesters I've taught this class, people forget about the premium in the bad state of the world. So write it down. Always pay the premium. You always pay the premium. That's guaranteed. You're definitely paying the premium. In the bad state of the world, you're getting money from your insurance company back. You're getting a payout. Okay, so we have a term for a particular premium. The actuarially fair premium is the product of the probability of the bad event, which we denote P, the probability of the bad thing, the probability that the insurance company has to pay out is P, times the amount of money the insurance company gives you, B. The payout is B. So this is the premium at which the insurer breaks even, right? Because imagine you're paying the actuarially fair premium. Suppose the bad event occurs with probability 10%, and in the case of the bad event, the insurance company gives you $10,000. What's the actuarially fair premium? 10% times 10,000 is 1,000. The actuarially fair premium would be $1,000. Suppose the insurance company insured 1,000 people like that. They take $1,000 from 1,000 people. We said that the bad event occurs 10% of the time. With enough insurees, roughly how many people will the insurance company pay out to? There's 1,000 people, 10% chance of an accident. How many people are likely to get into the accident? 10% of 1,000 is 100. And so they're going to pay $10,000 to 100 people, right? And so they're going to get, that's going to be $1 million. They're going to pay out. But they will have charged $1,000 to 1,000 people. They're going to have $1 million of premiums to use. The actuarially fair premium is a situation where the insurance company is breaking even. There's no load, there's no profit, they're just taking money in as premiums, they're paying that out in expectation. That's the actuarially fair premium. Yeah?
Can we step back?
Yeah.
You said that you could make payments even during bad periods?
Yes.
I mean, if I got injured at the job,
Yeah.
I collected workers' comp, I'm not going to continue to do that.
Your paychecks would,
I wouldn't be working anymore.
Right. So workers' comp, you can think of it this way, that the premiums are adjusted such that that part that you wouldn't pay it when you're in the bad state is. But we're talking today about, so it's true, workers' comp, there's no paycheck, they're not deducting your workers' comp fee. But you can think of the premiums as being inflated to cover that. But today we're not going to talk about any like actual insurance market, right? You're also not paying UI when you're unemployed. So we're not going to talk about any actual social insurance program today. Today we're going to talk about a very stylistic insurance world so that we try to fix the fundamentals. We have the vocabulary down. But yeah, I mean, you always pay the premium is true of the problems you'll do in this class, is the way to think about it. Because otherwise you have to adjust the premiums in the good state of the world such that they cover the bad state of the world, which is roughly what happens in reality. And also there's some just sort of government payout in these programs that isn't necessarily insured, the other way to think of it. But in this class, in all problems, you pay the premium in all states of the world. Okay, but thank you. Actually, when you guys have questions like that, it's terrific because there's like a world in which I'm painting for you which is totally unrealistic, and it's good occasionally to be reminded how that departs from reality. So when you have questions like that, it's really great. It's terrific. Okay, let's do another example of the actuarially fair premium. The probability of an accident here is 1%. So this is important. It's not just what you lose when you have the accident, it's your total consumption level in each state of the world. Because there will be problems where you have $100,000 of consumption. In the bad state of the world, you lose $20,000. In the good state of the world, you don't. Right? So you have to calculate utility with 100 versus 80 if there's no insurance, right? Does that make sense to everybody? It's not just what you lose, it's because the utility functions we look at have diminishing marginal utility, so if you don't use the right level of consumption, you'll get the wrong answer. Okay, so this is in the no state of the world accident, you consume $50,000. In this case, your full consumption is wiped out if you have an accident. You lose the $50,000. So the actuarially fair premium here, and so in the case of full insurance, where you get a payout of $50,000, the actuarially fair price of this insurance policy would be 1% times $50,000, also known as $500, right? Everyone with me? Good. So the insurer breaks even collecting $500, say from 100 people, and paying out, one of them will on average get into an accident, and they'll pay them $50,000. They've collected $50,000, they'll pay out $50,000, the insurer breaks even. Okay. So I'm going to run through some insurance theory results. Individuals, okay, we're going to talk about risk aversion more in a second, but individuals value insurance because of diminishing marginal utility. The fact that your 50th piece of pizza gives you less utility than your third piece of pizza is the whole reason you want insurance. Because remember, diminishing marginal utility was the reason you wanted to smooth consumption between period 1 and period 2. It's the same reason you want to smooth consumption between the good state of the world and the bad state of the world. It's all the same thing. We'll talk more about it in a second. Full insurance equalizes utility in all states of the world. You're fully insured. You have flat consumption again in good times and bad times. You have flat utility in both states of the world. The key result is that with actuarially fair pricing, individuals will want full insurance. We'll do a numeric example of that in a second. With actuarially fair pricing, you want full insurance. You want no risk. Full insurance is the efficient market outcome. If folks are left with less than full insurance or no insurance at all, and they would want insurance, that's considered a market failure. The market has failed to provide the efficient amount of insurance to agents in the market. Okay, now we're going to talk about the expected utility model. So this expected utility is the way we think of an agent's utility over risk, over an uncertain set of outcomes. Suppose P is the probability with which the bad event occurs in this case. So the accident occurred with probability P. Your expected utility, and there's two levels of consumption. Your level of consumption when you have an accident, C sub A. Your consumption when you don't have an accident, C sub N. Your expected utility over these two states of the world, accident, no accident, is simply the sum of your utility in the accident case multiplied by the probability there is an accident, P, plus your utility in the no accident case, so U of C sub N, times the probability there is no accident, which is simply 1 minus P. We're always talking about binary situations. They're either no accident or accident. It's simply the sum of those two utilities, weighted by the probability of each of those outcomes. Notice that expected utility is not expected consumption, right? We're not weighting consumption by probabilities and adding them up. We're weighting utilities. You have to plug the consumption level into the utility function to figure out your utility in each state of the world and weight that by the probabilities and sum. Does everyone see the distinction? You want to use this is expected utility, not expected consumption. Suppose our utility function took the form of U of C equal to C to the 1/2, i.e. square root C. Right? That's our utility function. If we have a consumption level of 4, our utility is 2. It's just a square root of consumption. Let's figure out what our expected utility in a few different situations is. Let's first do our expected utility without any insurance, if we face the full risk of the gamble, of the accident. So again, this is the same situation where our consumption in the no accident state is $50,000, but if we have the accident, the full $50,000 is wiped out. Okay, so with probability 1%, we have a utility of 0 to the 1/2, right? With probability 99%, we have a utility of $50,000 to the 1/2. No, to the 1/2, you have to do U of C. So in that case, your utility level is 221.37. Now let's do our expected utility in a case where we have partial insurance, where we're paying $250 for $25,000 of coverage. So when the bad state of the world occurs, we have an accident, we lose $50,000 of consumption, we get $25,000 of payout from the insurance company, but we still pay the premium, right, of $250. So and this is a case where with probability 1%, we have the accident, so we have a utility level of $24,750 to the 1/2, right? And with probability 99%, we just pay the premium and have $49,750 to the 1/2 in utility. The weighted average comes out to be 222.39. Comparing those two numbers, is partial insurance better than no insurance? Yeah, right, utility is higher with partial insurance. Now let's do the full insurance case. This is a case where you're paying $500 for $50,000 of coverage. This is full actuarially fair insurance. So with probability 1%, you pay the premium. With probability 1%, you have the accident. Your $50,000 asset is wiped out. You get a $50,000 payout from the insurance company, but of course you've paid the premium as well, so you have a consumption of $49,750. You have a utility of $49,500. You have a utility of $49,500 to the 1/2. And that happens with probability 99%. If the premium is higher here, because the insurance is higher here. With 99%, you have no accident, but you pay the $500 premium. This is full insurance. Your utility level in both states of the world is exactly the same, full insurance. And so your utility ends up being, in this case, 222.49. So is your utility higher with full insurance or partial insurance? Full insurance, because it's all actuarially fairly priced. We know this person was going to prefer full insurance, so all other options. EU's highest with full insurance is because it's actuarially fairly priced. Now let's talk about risk aversion. Risk aversion is the extent to which an individual is willing to accept a lower payoff in exchange for certainty. It's what you're willing to give up in order to not face risk aversion. In models where utility, U of C, is concave. Concave simply means that the slope at low levels of consumption is steeper than the slope at higher levels of consumption. That the slope goes down with more and more consumption. What's another way we describe that? 3-word phrase. First word starts with a D. Marginal utility, exactly. Diminishing marginal utility. Because if this is the utility function I'm plotting here, the x-axis is consumption, this is U of C. Maybe go ahead and label this. U of C is the y-axis. C is the x-axis. What does the slope tell us in that case? Marginal utility, right? The slope is going to tell us marginal utility. And what's happening to the slope of this curve? It's getting smaller. It's diminishing. Marginal utility is diminishing as we go from left to right. The same is true of that curve. They both exhibit diminishing marginal utility. In other words, both of these utility functions feature risk aversion. So in models where U of C is concave, if an individual is risk averse with payout with respect to any gamble, more curvature is also going to mean more risk aversion. So this is this is the plot of a curve of the natural log, ln. That's the square root. So this is where U of C equals ln C. This is where U of C equals C to the 1/2. This one has more curvature than this one. What does curvature really mean? It means that the slope is getting flatter more quickly. We start off with a steeper slope and it gets flatter faster. That's all curvature means. Curvature means it looks more like a C, right? It looks more like a C than like an up and down, than a straight line. So the more curvature, the more risk aversion. What I'm telling you is that the ratio of the marginal utility of the first unit of consumption to, say, the 10th unit of consumption, the marginal utility of the first unit of consumption divided by the marginal utility of the 10th unit of consumption, is a higher ratio for this curve than for that curve. This one is more curved, it has more curvature. Because what I'm telling you is that the marginal utility drops off faster over here. So if there are two states of the world, the good state of the world and the bad state of the world, the good state of the world is where you're all the way out here. The bad state of the world is when you're in here. The same would be true there, right? The same point on the x-axis. I'm saying that that is more painful to you If you're over here, then over there. Because the marginal utility you're getting from having lots of consumption is really low, and the marginal utility you're getting from very little consumption is really high, in this case more than that case. What do we want to do when we smooth consumption? Equate marginal utilities. So in this intertemporal savings model, how do we transfer consumption from period 1 to period 2? What do? We save, right? We save part of our period 1 income and transfer it to period 2 through a savings vehicle. In the same way, in this model where we're smoothing across states of the world, we transfer income from the good state of the world to the bad state of the world through insurance. We give up consumption in the good state of the world in order to get more consumption in the bad state of the world. That's what insurance is. We pay the premium all the time, sure, but the bigger the premium, the more the insurance, right? We're transferring consumption from the good to the bad by insuring more. The more curvature your utility function has, the more insurance you're going to demand because you're more risk averse. The 3 following statements are all the same thing. Faster diminishing marginal utility, more curvature in your utility function, faster diminishing marginal utility, more curvature in your utility function, more risk averse. So I'd like for you all to go home and think a little bit about this. Think about what I was saying about equating marginal utilities in the 2 states of the world, what having more curvature means in terms. Think about this a little bit, and I'm going to ask Vincent to talk about it with you again next week after you've had some time to think about it. Think hard about it. Remember, stuff I like rears its ugly head again, right? Yeah. So I like this stuff. Okay, so I'm going to say it again in words. Risk aversion measures the extent to which an individual is willing to bear risk. The more risk averse you are, the less inclined you are to bear risk, the more you're willing to pay to get rid of risk. Risk averse individuals have rapidly diminishing marginal utility of consumption. They are very afraid. Another way to say this is they're really afraid of consumption falling in the bad state of the world. They really don't like low levels of consumption in some states of the world. Individuals with high risk aversion will buy insurance even if it's priced at more than is actuarially fair, because they love insurance, right? The risk premium is the amount that risk-averse individuals are willing to pay above the actuarially fair price. Okay, so first let's talk about adverse selection for a second. So far we've talked about there being an agent, a driver, et cetera, et cetera. There are lots of people, and we're all different, right? When it comes to healthcare insurance, we all have different health risks. Some folks are young and come from families that don't have chronic conditions, and they're less likely on average to have high medical expenditures. Some people are older, which makes them more of a risk for medical expenditures. They come from families that have a common trait of chronic diseases, right? Some people are really safe, and some people are evil Knievel, right? They make choices that make them at higher risk for medical expenditures. Suppose we compare, a daredevil to someone who's not, but they look the same. They're the same age. They're the same height and weight. They work the same job. Everything you can see about them, except for what they do with their weekends, is the same, right? But one is actually going to have much higher medical expenditures because they like to jump off buildings on the weekends, right? Like do crazy stuff all the time. But you can't see that in them, right? So these are people, we think of them as having heterogeneous risks. All people have somewhat heterogeneous risks, right? Asymmetric information means that one side of the market has information that the other side of the market doesn't. So in the case of, let's call the risky guy Evel Knievel and his brother, who's really safe, right? In that case, they know, right? Evel Knievel knows that he does crazy stuff, right? And imagine his name isn't Evel Knievel. He's like some secret Evel Knievel, right? You can't tell from his name. That's asymmetric information because he has this private information about his healthcare risks, his healthcare expenditure risks, that the insurance company could never see, right? He knows that he has crazy stuff he's going to be really expensive to care for. That's an example of asymmetric information. One side of the market has more information than the other. Adverse selection means that, so when the insurance company offers a really generous insurance plan, Evel Knievel is the first in line, right? Because he knows, regardless of what they're charging, he's going to want that insurance. He's going to have 4 operations this year, right? He knows this. He wants really generous insurance. Adverse selection just means that when a product is offered, and there are heterogeneous risks, right? When an insurance product is offered, and there are heterogeneous types, the people who show up are unlikely to be representative of the population at large. The people who demand insurance are less likely to be the low-risk type. The more risky type are more likely to demand insurance because it's worth more to them. The low-risk types are not less likely to show up. In other words, adverse selection means that individuals with the highest risks are most likely to want insurance. Thus, insurers charge a higher premium than is actuarially fair for the population at large, which causes low-risk people to forgo insurance. So if I was trying to insure all of you, right, if I knew the average medical expenditures of all of you, I sort of had your history from last year, and I tried to charge a premium. For you low-risk types who are also not that risk-averse, you probably wouldn't want in, right, because I'm going to charge this flat premium that's across everybody. You're the low-risk guy. It's not a good deal for you. You're going to opt out, which means that the people who buy my insurance are actually going to cost me more than I expected them to. So I'm going to jack it. So knowing that, I can see that. I've taken this class, right, so I know that. So I'm going to set that initial premium higher than is actuarially fair for this classroom. And then the low type is definitely not going to go. I'm definitely not going to go for it. Maybe the next lowest type is not going to go for it, et cetera, et cetera. So I keep jacking up the premium. I get less and less of the market. Eventually, I might charge a premium that is actuarially fair for that one really high-risk guy. But does anyone else want to pay that premium? No, it's fair to him. He'll buy it. He'll get full insurance. But do we have a market failure? Yeah, because no one else has insurance, right? That's where so that process of the really high-risk types only buying insurance, and so the premiums go up, and then only the even higher risk types want to buy insurance next year, and the premiums go up, that's called a death spiral. Because eventually the market fails. It fails almost everybody except the highest risk types. Premiums are super high. It only covers the sickest of people, if they can afford it, right? If they can actually afford the premium, which is another issue when it comes to insurance, is like ability to pay versus risk type. But let's assume everyone can buy the insurance for today alone. Let's make that assumption. I'll only be insuring those really high-risk guys. Okay, there's two kinds of equilibrium. So we just talked about a separating equilibrium. Asymmetric information does not always cause market failure. In fact, it doesn't. So just now I give you an example of a separating equilibrium where everybody but the highest risk type dropped out and I was only insuring the highest risk type, right? Okay, but that doesn't always happen. There are cases or situations where the low risk type knows that the premium is above what's actuarially fair for them, but is still willing to buy insurance. What is true in that case? The low-risk type is very risk-averse. When the low-risk type is also very risk-averse, he or she is also willing to buy the non-actuarially fairly priced, for him or her, insurance policy. They're willing to pool with the high-risk type. The insurance company is pricing for the higher-risk types, but the low-risk type is willing to buy as well because they're so risk-averse. They're willing to pay a premium to get insurance. That's the case of a pooling equilibrium, because the low-risk type is pooling with the high-risk type because of their level of risk aversion. All types buy full insurance, even though it's not actuarially fair to low-risk types. This is not a market failure. Everyone is insured. Is there some cross-subsidization going on? Yeah, low-risk types are paying more for insurance than they would if their insurance was actuarially fairly priced. But that's not market failure. That's equity. That's not efficiency, right? They're subsidizing the high-risk types, but they're getting full insurance. So a pooling equilibrium is efficient when it comes to the market. There's another kind, what we just talked about before, separating equilibrium, which where the high-risk types are buying full insurance, but the low-risk types are not sufficiently risk enough to want to pay the higher than actuarially fair price. So that's a situation where I keep bidding up the premiums and the lower risk types keep dropping out, right? In the end, only one guy, the highest risk type is insured, everyone else is uninsured. That's market inefficient because people want insurance. There's a quantity gap, right? Any situation where some people lack insurance and would want insurance or are not fully insured is a market failure because there's product not being supplied because of asymmetric information. The source of that market failure is asymmetric information. Why is it a source of market failure? Because suppose I know that I have a family trait for some disease, right? I know it. And I'm willing to go to the insurance company and say, hey, listen, I know I need more expensive insurance. I have this blood test. I know we're all even. You've seen my blood work. I have this trait. I'm more likely to get this disease. Charge me more. I want to buy the insurance. Why is the insurance company going to believe me? Sure, I'm telling them about this disease. My extreme interest in insurance is suggestive that maybe I know that my medical expenditures will be even higher than that, right? No matter, suppose instead I am the low risk type. I have no medical history of illness. I, cross the street only after checking both ways 3 times, right? I wear my seatbelt when walking, right? I am the low risk type. there's no way for me to prove it, right? Because I can show them video of me driving, and I can show them video of my blood work and all stuff. There's no way for me to credibly prove to the insurance company that I'm the low risk type, that I'm the lower risk type than what they think I am. And that is asymmetric information. And that's why there is this source of market failure. That inability for the information to be fully shared leads to the market failure that leads in a separating equilibrium to some people being uninsured, and that's the market failure. If we have high, risk-averse enough low types, risk-averse enough low-risk types, then we have a pooling equilibrium and we're fine. We're fine. Okay, so I'm going to go through. You know what? I'm going to save all of this for next time because that's what the other class did, and that's fine. We have some slack in the next lecture. But I'm also going to build in. So I get the sense that you guys really like the practice problems we do in lecture, right? They help you kind of do a problem while you're like. Because I feel like if we don't do problems in class, you walk out of here feeling like you got it, only to learn later that maybe you're 10% confused. So I'm going to add some practice problems, I think, for next week. We'll turn some of these into practice problems so that we can do problems together. So when you come in next week, do me a favor, review everything we've covered so far. And that way we can start exactly where we left off. Okay, so let's get ready for our discussion. Please switch seats as is needed. Let me get the names. And don't worry, all of this will be cut out of the video. None of this will be posted when it's all 9. Okay, so today is Valerie, Diego, Shiraz, Tal, Teresa. Is it Teresa or Teresa? Teresa. Maniza, Teresa Marina, Kelly, and Vasundra. So, oh, you guys have done this. Okay, you guys probably came in with this in mind. Nice work. Okay, so this week it was 2 articles, the Porter article and the Norris article. Okay, so what do you guys think? Do you think the current proposals are on the? Oh, sorry. Sorry. I thought you were blocking the light. So you guys think the current proposals are on the right track, Maniza?
No, I mean at least based on the Norris article, just given the election timeframe, a lot of the proposals are very high level, very ambiguous.
Mm-hmm.
They don't really have any teeth, and they're not really focused on making the changes that actually need to happen.
Okay, so they're discussing some stuff,
Yeah.
but at this vague level and maybe not with the right goals in mind. Valerie?
I would rather go with the arguments of Porter article,
Okay.
especially with the CBO, what they're saying about the ratio of federal debt to GDP.
Mhm.
So like in 10 years it would be 100% of the GDP, and in 30 years it would be 200. So for me it's like a pretty straightforward analysis that shows a clear trend towards something not really good.
And you don't think the policies being proposed are really addressing that trend?
Yeah.
Okay.
That's it. I mean, I think they're trying to fix some loophole, but it's not really something substantial.
Okay.
And another point that
Mhm.
I want to make is from the Nobel Prize from your school.
So what? I'm sorry?
Mr. Saez.
Oh, yeah.
And I think they were making a good point when they're saying that there's like a scope for taxing really high income people a lot more than we're doing, well, the U.S. is doing. Right?
That's what he thinks. Yeah, he thinks that there's some role for that. Tal, you had a point?
Yeah, just tapping into the only last class, we talked about 2003, where they did this research. They used, what was it called? I think dynamics.
Dynamic scoring, yes. Way to tie the last lecture in. Extra points.
And they found out that raising the tax rate is not really going to solve all the problems, and it's not going to ruin the economy.
Mm-hmm.
So
Or you mean the O3 analysis was about cutting tax rates?
yeah.
Didn't enhance the economy as much. So you're saying the reverse. Okay, got it. Yep. Interesting. Excellent. Other points? Share with us.
If you look at both arguments, one is kind of very unilateral in the sense that we need to cut taxes, right? And then the other one is kind of like having a bit more of a balanced approach, which makes more sense.
Mm-hmm.
But neither are giving enough specifics to really say, okay, this is the way to go.
Okay.
If you look at the article where it talked about what Obama is trying to raise 2.4 trillion over, right? That makes sense, but at the same time, it's kind of like, how is he going to do it? And it doesn't seem like it's very apparent.
But I think the key point is to raise taxes.
Right.
Or to raise revenue, right? Whether that's cutting tax expenditures or cutting spending on the other side, it seems like we might someday need more revenue, or some more net revenue, right? Whether what side it comes from. Vasundhara.
Yeah, especially in the second article, he talks about taxing the highest income earners.
Yep.
And really raising the tax rates, like, he gives two examples, like in the 80s, the tax rate was almost like 70%
Mm-hmm.
for the richest in America. So he says that if we tax them, that will definitely generate more revenue. He even says that, okay, people might evade taxes. He gave instances from Britain that people, he said, a lot of people move to Switzerland and everything
Yeah.
to evade taxes. But then he says again that, these kind of measures are temporary. People can't, like, move to Switzerland forever.
Yeah, so what I thought was interesting about that, so I think actually people can move to Switzerland forever. This is me not agreeing with it, because I mean, Switzerland's lovely. No, but I think part of it is that once people have moved to Switzerland, you might have gotten all your movers, your elastic part of your population may be gone. And who's left at that point may not be so willing to leave. Because they would have left, you've sort of gotten the people who are willing to leave their home country and go live elsewhere. That's what I would interpret that as, but that's, I don't know. I found it surprising for him to think that they would come. I don't think, some people do come back, right? But the idea, like especially in Europe, right? Like Switzerland it's not that crazy. It's not that crazy to do. But anyway, go ahead.
Yeah, so I kind of supported that if you tax the highest income earners at a really high tax rate and cut down the tax preferences like capital gains and things like that, it would really increase the revenue.
Okay, but so I'm gonna so go ahead.
Yeah, it's okay.
Okay, so because I want to ask the group a question based on what you just said, but go ahead first.
Well, I think they were saying that to increase taxes across the board for everyone, but increase taxes to the higher income individuals at a higher percentage.
Mm-hmm.
And that way to improve on revenue, but also they were saying to, not only to increase taxes, but to eliminate loopholes as well.
Reduce the tax expenditures.
Specific on what those loopholes are and to what degree, and to ensure that there isn't a
But even if we don't,
turnaround period.
even if we don't eliminate those loopholes, there would still be like getting 48%. It's like significant benefits of taxing them very high.
Right, that's
So-
something to just tax everyone across the board.
And to have a bigger, so tilt it more.
Right.
So do you guys support this idea of increasing tax rates at the top more?
Yeah.
What does that mean? Do you mean increasing the progressivity of the ordinary income tax, or do you mean taxing investment income more? What do you mean?
I think there's just more money that you can kind of squeeze out of the people at the top of who are paying most of the taxes. I think that an important point is, like, if you look at the whole Laffer curve argument, right?
Mhm.
I feel like, it's all about like the middle ground, right? So you don't have to necessarily, tax at 70%, but if you can even get back to, a few percentage points like where you were a couple of years ago, right?
Mhm.
The thing is, you don't know where that peak is.
No, we don't. Yeah.
So the thing is, I think that it's worth experimenting. I think that it's become such a kind of like politically charged discussion that people just kind of are ready to just kind of look the other way. That's why I feel like you're not going to get anywhere saying, okay, let's cut taxes. You're not going to get anywhere saying, let's get back to 70. You have to kind of get back to, okay, well, let's start back where we were a few years ago.
Okay.
And then work from there,
Okay, that's one point. Tall.
Well, I think the discussion, since we're talking about top income earners, most of their money is not income tax, so it's, capital gains and assets, it's, different things. So it's a very difficult tension, because on the one hand, as like the memo we did, we really want, investments to increase on the one hand. On the other hand, we want the money that these top income earners to go to government revenue. That's one point. That this tension is something that, is hard to resolve. Another point is, I think that the discourse about, cutting taxes, politicians say, they don't really say anything about, government revenue, welfare, how to.
It's become popular every few years to talk about cutting taxes, right? But no one talks about cutting. Some people talk about cutting spending, but there's not enough specifics. It's part of what one of you said, and so we keep talking. The conversation is always the same, right? Okay, so what if I told you guys that capital income is thought to be more mobile or more elastic than labor income? Would your reactions change?
I think
There's no right or wrong answer, right? This is the one part of class where it's about feelings.
you have to.
Just given that capital income is then more elastic, then it can escape the tax rate. So I guess there's a risk of it going abroad or, moving elsewhere.
Where?
So that is a sort of vital part of improving or But,
You might want to start to temper
yeah.
your,
You
okay.
definitely need to temper it. I mean, it is, right now, at least it is, as I think Paul said, it's concentrated at the top.
Mhm.
If there was a way to make kind of all levels of income more, more part of capital investment, that would probably be beneficial.
It might improve horizontal equity in some ways too, if we continue to tax advantage it.
Yes.
Other points?
I think it's a delicate balance, and I think what you have to be careful of is, you have to be more concerned, really, people at the lower end of the, who pay less taxes, because, like, I know there was an example in, like, I think Beaverbrook, where in '90, where, you know, Margaret Thatcher's government.
Yep, the poll
tried-
tax.
Right?
Mhm.
I mean, they were killing people in the streets, right? And I mean, you have, I mean.
So Shiraz worries about revolution.
No,
Yeah,
exactly.
yeah.
And I mean, I feel like now more than ever, it's more and more of a reality. So I mean, you don't want people on the streets. So to the
Right.
extent that, you know, if you go back to 39% and people aren't in the streets, I think we can stomach it.
So
But if you
maybe it's a
say-
question where, so I'm going to tell you this one fact. So the income distribution is more concentrated at the top than ever before, right? So by raising tax rates at the top, we'll get more revenue than we ever were able to before. But I'm going to tell you there's not that much revenue there, shockingly. A middle class, like raising middle class taxes a little, is, you know, it's very difficult to balance the budget on the backs of the poor and rich alone, right? Cutting lots of spend, it's actually hard, right? We're gonna have to change how the middle class interacts with the tax system. It might be closing expenditures, it might be raising tax rates, it could be something. But that's why this is a hard conversation, right? Is that it's really fun to pick on people who you think are not this vague middle. So I'm gonna open it up to the group. Anyone have a point they wanna make? You guys can make points too, but Jeff.
Capital flight, basically, countries throughout the world are suffering from over expenditures.
Mhm.
And by putting more penalties and more cooperation amongst countries.
I'm sorry, what? Across countries, you said?
Yeah,
Yeah.
more cooperation amongst countries.
Oh, yeah. Mhm.
And increasing penalties for not reporting income, because any income that America makes should be reported.
Should be.
reported.
Yeah, I mean, your Swiss bank accounts are technically supposed to be reported to the U.S. government, right? I mean, yours, because all of you have one, right? Yeah, any Swiss bank account should be reported, yeah.
Any reporting would be, you know,
So increasing penalties with international cooperation,
Right.
it's something you would go for. Vasundra.
So, you mean to say like there's no way that we can actually get taxes out
We
of the
can, but we
highest
I mean, we can, but there's a limit to how much you can raise. Like it's a pot, but you know, we're taxing it pretty heavily already, right? And there's only so much money. There's a lot of money in the broad middle. I'm sorry. Andrew, I'm sorry, Andrew.
I think the
I just
question,
think of you as time master, sorry.
I think the question is then, how do you grow the middle class? Is that something you can do with the tax system, or is that just?
To have more income in the middle class. Interesting. That's like a long-term project.
Yeah.
Yeah.
Well, it seems like the better route than just kind of constantly complaining about who's getting taxed and who's not getting taxed.
To think about what we're doing on the spending side, where the investment, where are we putting our spending dollars?
Right.
And are we investing in the middle class, is what you think of.
Make that middle class bigger.
Okay. Other points. Kelly, then Valerie, and then Tal. And then we're going to maybe do one more. And we'll close.
I thought was interesting was that only recently, like during the Clinton administration, did they say that, like they figured out that by decreasing taxes didn't just automatically improve the economy, like the economy, or it was in either the Clinton or Bush administration, where the Bush, where the.
I mean, this is still time series type stuff. Like, you know, it's hard to say for sure. This seems to be like what the model suggests, et cetera, et cetera. There's no evidence that that happens, is the way to put it. Yeah, there's no evidence that decreasing taxes led to more economic growth.
But this is like almost very recent news, it seems like to people. But on like a macro level, just this, I think the best part, the good part that's coming out of like this discussion is illuminating like the devices that the very wealthy have for
Okay.
avoiding taxes. I think that's the best part, but I think that, you know, it seems like we're raising revenue for more Band-Aid solutions.
Mm-hmm.
And so that's kind of like, I think that these policies, other than tax policies, are what we need to change.
Interesting.
So that we're funneling revenue to places that are going to make systemic change instead of what's going on.
To grow the pie. Our spending should be more aimed at growing the pie in your world. Valerie, I think you.
I was going to say something along those lines.
She got it for you?
Yeah.
And then Tal, I think you were next.
Just like a thought that I have when we talked about General Electric, I mean,
Yeah.
it's crazy that they don't pay taxes. I mean, here we're talking about, you know, the wealthiest, but this is a company, an American company, and it's amazing
shocking. I mean, they're welcome to the brave new world of multinational tax, right? It's companies live across borders. Some people do, and they're hard to tax. But those stuff that's in the U.S., we know where you sleep, right?
Yeah,
And we tax you accordingly.
Politicians like to talk about how whatever side they're on, they want to cut taxes or raise taxes or whatever, but, the approach to companies should also be,
So Tal wants to bring corporate taxation to the forefront of American tax policy.
No, but I also think that companies are richer than countries these days.
But are companies people?
No, but there's only,
Supreme Court says that.
governance.
Sorry, what?
Supreme Court says
Says they are, okay.
Business ethics and things like that.
The Supreme Court needs many economics lessons in my world, but I'm not saying this court, I mean all courts, I mean all of them together. But this is great, so I will tell you this, our next one will probably be about spending stuff, I mean much to my dismay, but it'll be more about spending stuff. But I hope that these discussions and reading some of these outside articles has made tax policy something you think of as more interesting than you did maybe when you walked in. And so I hope tax policy is alive in your life, like it is in mine. Is this a point? I think we have to go, but
Just I wanted to know your viewpoint. Like, what do you support? Like, tax will decrease or increase?
I'm ready for tax reform. It's time to figure out. I actually think the American, maybe this is me being honest, I think the American people are a lot more reasonable about this stuff than our politics makes it seem. I think our politics makes it seem like the American people only have this endless appetite for tax cuts and tax cuts and tax cuts. But I feel like if people look at the deficit and the debt and they're like, yeah, you know what, that's really big. And I think if we had this very honest conversation where more people actually represented their voters and we said, we got to cut spending, we got to raise taxes. We have to figure out what the right ratio is through honest negotiations. I think there was a debt deal on the table for 2-to-1, spending cuts to tax increases. I mean, is 2-to-1 my number? No, but if that's the outcome of a negotiation, I could live with that, right? But now we live in a world where, I think, so that 2-to-1 means a third of it's coming from tax increases, right? And we have a world where people say, you want a third from tax increases? How about 20% tax cuts instead? And let's meet in the middle at 0. Right, and that's really, to me, I mean, that's my politics, but I also am very sensitive about taxing certain kinds of things, and I have my crazy views about integrating the corporate code and all this stuff. But, I think we're in a hard spot as a country, and it's very hard to imagine cutting anyone's taxes at this point. And I mean, I'm talking about low-income people, middle-class people. No one's taxes can go down anymore. We've got to pay off. We have to spend less, and we got to pay for it better, in my opinion. But hey, that's opinion.